Folks, it is getting downright nasty out there, folks. We got some things to go through in today's video. Some of these things that are transpiring, you couldn't even imagine these happening 1 year ago, 2 years ago, that are now transpiring at this point in time. And it's getting downright nasty between different companies. I want to show you some of that in today's video. We're going to talk about certain stocks, if I view those stocks as opportunities to buy, where I'm going to share some perspectives on the market, growing a portfolio later on in this video that I think are very important, and kind of understanding where the real opportunities are versus not the opportunities are, and just getting yourself into stressful situations. And me being in the market so long, I've been in some very stressful stocks over time. I've been in some huge winners, and I just want to share some perspective and give you some value toward the end of this video today. But first off, we got to talk about some big news stories here, because I can tell you it's starting to get nasty between companies. When revenue growth gets hard for companies start fighting like there's no tomorrow, folks. And this is exactly what we're seeing play out now at this point in time. I appreciate everybody joining me as always. Thanks so much for being subscribed, folks. Got some important stuff to take you through here, okay? Alphabet shares dip on the report that Samsung phones might switch to Microsoft Bing. What? You couldn't even conceive of this in the past. What? Samsung is reportedly considering changing its default search engine from Google to Microsoft's Bing for its lineup of smartphones. Alphabet shares were down about 3% or so here today. Alphabet pays billions of dollars to maintain Google's default search status on mobile phones. Check this out. I don't know if you guys knew this or not. This is shocking. Google pays billions of dollars every year to phone manufacturers, including a reportedly $20 billion annually to Apple. $20 billion. Man, did Steve Jobs create one of the most incredible business models ever in the history of mankind. I mean, imagine making $20 billion a year for something that's not even yours. I mean, we're talking about Google has to pay him that much? You'd be flipping my flapjacks to serve as a default search engine. In return, the search company reaps billions of dollars worth of advertising, which has long been a profit center for Google. Samsung and Google's deal is up for renewal soon, the Times reported, and is worth an estimated $3 billion in revenue to Google. Samsung is a major Android manufacturer, and the news that Samsung would consider a switch reportedly surprised Google employees. Wow, okay, that's wild, says Google employees here, okay? Now, this is fascinating because you couldn't even have thought of this in the past, right? I mean, this you couldn't even conceive of this, right? And here's an important fact, okay? A lot of people are thinking like Google stock's really cheap right now. That's what they think. They think Google stock's really cheap right now. And I want to share my perspective on, is Google stock really cheap or not really cheap? And is this a time to get in Google stock, or is it going to be just a big headache, okay? So here's my perspective on this, okay? The fact is, Google's not necessarily really cheap right now. I mean, if you pull up the last, let's say 5 years or so, 4 or 5 years, in regards to what its PE ratio has been in the past versus what it is now, it's kind of in line. It's not like you're getting some outlandish, wow, it's, on the floor valuation for Google right now. So I couldn't really say it's necessarily really cheap. I also wouldn't call Google expensive by any stretch of the imagination. But the fact is, this stock isn't really, really cheap based upon any historical kind of norm for this company, okay? And I can tell you, as somebody that's been an investor of Meta over the years, okay, was it worth it? Obviously, we're doing well in the position. We'll do a lot better in future years, right? But remember, this is a stock I've been in for quite some time, right? I have shares that date all the way back to 2018 in regards to Meta stock, right? And Meta stock's a stock that has, been in, oh my gosh, I mean, the amount of crap this company has had to go through over the past, 3, 4, 5 years is ridiculous, right? And they were already involved in some crap when I got into the stock, right? And so you got to understand, think about somebody like myself that's been in Meta for years, right? And have I made good money on Meta? Absolutely. And will I make probably a lot more money on Meta? Yes. But you got to think about where's the best opportunities for your money in the market. The fact is Meta one of my best returners as far as percent? Not even close. Not even remotely close, okay? I do think Meta is going to play some catch up over this next few years, but the bottom line is, I've made a big dollar amount, 175,000, but percentage basis, and you look at many of my other stocks, they've blown Meta out of the water over the past few years, and it's not even close. You also get to think about the mental energy you have to put into it. And the fact is, Google has several government agencies on their back now. okay, doing all these investigations, all this crap, okay? And you have that going on. You have Samsung, pretty much the biggest Android partner, or certainly one of those, talking about going with Microsoft Bing. And believe me, if Apple sees Google in a harder situation, especially if Samsung goes with Bing, you think Apple's going to be just okay with their $20 billion a year? No, they're going to want 25, 30, 40, 50. They're going to go for the juggler, right? Because remember, who's the biggest competitor on smartphones? Android. So if you think about it, I mean, I don't know if Apple would really be that heartbroken about Google being hurt severely. Even if it hurt Apple a little bit, I wouldn't be surprised if Apple would look at that as a situation where that's fine with us, okay? So the fact is Google stock a buy? My view on that is it's an okay buy if you're a long-term investor. But I think there's far better opportunities in the market. Can Google make money over the next few years? Absolutely. But are there far better opportunities in this market? There's going to be far less stress and probably a way better risk reward? Abso-dang-lutely. And that's the hard thing as a stock market investor. You've got to look out there and say, what's a better risk reward? Meta still, even though I know Meta's come back so much over the past, 5 months or so, Meta's still a far better risk reward profile over the next 5 years than something like a Google stock, okay? Because at the end of the day, when you talk about Facebook, WhatsApp, Instagram, those don't have to be defaults. People are going to download those regardless. They don't have to be defaults on Google. They don't have to be on Android. They don't have to be defaults on Apple. It doesn't matter. People are going to use Facebook, Instagram, WhatsApp, regardless of the situation, okay? And so that's kind of the way I think about that. Meta's gotten out of the whole governments on their back left and right. They already went through that phase, whereas Google's just starting to go through that phase over the past few months and probably is going to be going through that phase for the next, 2 to 4 years. I mean, we're not talking about months, folks. We're talking about years. And so that's where you got to kind of look at this game and say, where's the best risk reward profiles for your money out there? Could you make money in Google stock over the next few years? For sure. Is it going to be extremely stressful? Absolutely. Is there going to be way better risk reward profiles out there? Absolutely. No question about that. Okay. It's getting even nastier, folks. Big banks, you better wake up. Okay. Apple just launched a savings account where you're going to get 4.15% interest rate. Now, from my understanding, Goldman Sachs is kind of the back-end bank that Apple's using in this situation. Now, this is a problem, folks, for the big banks, okay? This is a major problem, actually bigger than I think a lot of folks anticipate. I'm an owner of JP Morgan stock, okay, JPM. I own the stock in my dividends only account. It's a decent sized position, $7,000 position. That portfolio is probably $170,000 or $175,000 portfolio, something like that. So, it's a decent sized position in there. We've done well in the stock and it's paid us really good dividend money over the years, right? But I gotta be honest, I'm worried. Everybody's so caught up into, oh my gosh, JP Morgan, Wells Fargo, Bank of America, all these guys are going to have so much money coming in because of regional bank problems. Sure, that's been a short-term kind of help for them. But I'm actually concerned with these companies. I look at companies like JP Morgan, Wells Fargo, all those guys, Bank of America. I'm very concerned that here in early 2023, we're at peak earnings for the next few years for these companies right now. With how much competitive savings accounts are out there right now, CD accounts, more and more folks are going to wake up to the reality of I need to move my money out of these big banks and somewhere I can actually get a decent return. I've even personally done this recently where I was looking and I'm like, why do I have money in checking accounts or savings accounts that are earning me nothing when now through other competing offerings, I can get 4% on my money at the savings account at this institution or this institution. So as somebody that's even recently looked at, and that was something we never really had to even consider, other than there was a little time period in kind of late 2018, early 2019 where this was at least a little interesting. But for the past 15 years or so, we haven't even considered this. But now more and more folks are waking up and saying, I can get 4% over here, treasuries, CD accounts, savings accounts. And this is going to be a move of money out of some of these big financial institutions, in my opinion. And so I think it's very possible that JPM and many of these other big banks are in a time period of peak earnings and could be in a period of deteriorating earnings over the next few years. I think it's definitely a possibility, especially if loan growth remains a problem. If charge-offs is a problem, that's a whole other situation the banks would have to go through. But yeah, I think it's very possible. The earnings were amazing at JPM, but I'm really concerned that we're at peak kind of earnings time. Now, you might say, okay, Would you sell a stock like JPM? You know, $7,000 position there in the dividend account. Will I sell that stock? The answer is no. At the end of the day, for many of my companies, I'm not going to try to trade in and out of them based upon, well, you know, we might be at peak earnings, it might go down or something like that, okay? And even if we are at peak earnings for JPM, it's still at a relatively lower valuation. So my perspective on that, it's just not worth, for companies like JP Morgan, it's not worth me trying to time in and out of this and sell out of the stock and then try to buy it back in 6 months or 9 months or something like that. I'm going to hold through. And also, maybe I'm wrong. Maybe peak earnings aren't over this next quarter or two. And maybe they just continue to strengthen over the next several years. I don't know, okay? We'll see what happens with that. But I'm not going to try to time in and out of long-term investments by trading in and out of them, hoping I can time it out and sell JPM at whatever price it is today, buy back in 6 months or 9 months. Like, it's not worth it. And especially for my dividend portfolio, that's even to a greater extent, because my dividend portfolio, it's about making dividend cash flow in that portfolio. Sure, capital appreciation is nice, but it's about just making that dividend money. And Lord knows JP Morgan's making a ton of money, and they'll likely end up upping their dividend in quite a substantial way. I wouldn't be surprised over this next year, okay? And this just adds, this is almost comedy, because meanwhile, I was looking at the article, and what do I get an ad for? Synchrony Financial that has a 4.15% high yield savings account right now, right? It's an arms race. And I'm telling you, more and more Americans are going to wake up to the reality that they don't have to keep money in JP Morgan, Wells Fargo, Bank of America, and these big financial institutions, and that they can move them to other places and get 4% on their money or something like that. On $100,000, that's $4,000 plus dollars, right? And you may say, well, not everybody has $100,000. Yeah, but guess what? The money that the banks actually care about are the people that have more money, right? Or the people that have $100,000 in their bank account, $200,000, $500,000, million, right? And I mean, $1 million in a savings account, you're getting $40,000 plus dollars a year. $40,000 plus dollars a year. And so this is something I think more and more folks are going to consider. And this is going to be, in my opinion, something that will be bad for the banks and might actually show up in their numbers in the back half of this year. We'll see what happens as far as that goes, okay? ELF is now over $90 and closing over $90 officially, okay? Now, there's a few stocks that I think are potential next ELFs that I own right now, okay? And I'd love to kind of hear your guys' perspective on what you view as my next ELF. I think there's a few possibilities, right? My always the stock I've thought about, especially over the past 6 to 12 months, that is my next ELF is Honest, okay? Cosmetics, obviously Honest is in a lot more categories than something like an ELF. They've just been mismanaged, I'll be honest. Nick did a bad job just running the company. I'll just put it like that. And not in terms of the brand. I think their brand's in a good place, but they've done a bad job in terms of just, you know, decision making around pricing, around profitability, around earnings, around margins. They've made a lot of bad choices. And hopefully Carla takes this company up to the next level. So that's a possibility, okay? But maybe it won't be. We'll have to see. You know, it comes down to execution, right? Palantir. Maybe Palantir is my next ELF stock that gets me 1,000+% return. When I look at something like Palantir, the thing that's a little, how can we put it? I guess we can say confusing about a Palantir is it's not like an ELF. An ELF, I can go to Target, I can go to Walmart, I can go to wherever, and I can see the actual product right there. And I can see people actually going to buy it. Palantir, I can't see that, right? Palantir sells to governments. Palantir sells to big, large companies. So I can't walk in a store and be like, oh, there's somebody buying Palantir's product right there. Oh, wow, Palantir's got a bigger section in the store, right? So we'll have to see, but Palantir does have one of those sort of opportunities in front of themselves. It's just, I think from Palantir, I think they got to continue to execute the business model, but I think they also got to explain the story better. And I think they've got to put this company in a place where investors that have no knowledge of this company can feel like they got a good grasp of the knowledge within, you know, a day or two of looking into this company. And I feel like they're not there yet. They've got to be better at storytelling what their business is doing. Otherwise, big money is not going to come to the stock unless the numbers are so overwhelmingly good that they just have to come to the stock, okay? But maybe it's a stock like Palantir. Maybe that's my next ELF stock. Maybe it's Tesla? Maybe Tesla is my next ELF stock, right? It's already performed amazing for us. We're up $272,000 on the position. But obviously, it's off to a really nice run here in 2023. And, I mean, I got to be honest, the whole world's going to Tesla. The scale that this company is going to reach over the next few years is going to be fun, right? We got Cybertruck hitting the market. And over this next few years, like, everybody's starting to consider electric vehicles if you're going to go buy a new vehicle. So, and if you're going to start that conversation about actually considering an electric vehicle, you're always going to start with Tesla, right? We got a gigafactory likely coming in Mexico sometime soon. Oh my gosh, can we imagine the margins that could come out of a facility like that, right? Shanghai continues to just build bigger and bigger. The China opportunity is off the charts big, right? The worldwide opportunity for this company is off the charts big. The European opportunity is insane, right? And, wait to see what Cybertruck does in the United States of America and the conversation that's going to drive over this next few years as that product scales. Oh my gosh, okay? So maybe we could be at a time period where Tesla's actually becomes the next elf. Their margins, maybe even start ticking back up next year or something like that, right? Obviously, their margins should take a hit this year with not just all the pressures they've been facing in pricing, but also in terms of Cybertruck ramp. And we know whenever Tesla ramps a new vehicle, usually hurts profitability in the short term. But maybe Tesla's my next elf, and maybe this one's about to go beast mode. It's already started to go beast mode, but maybe it makes its next big run. We'll have to see what transpires with that. It's going to be a story around margins and net income over this next, I can tell you, 2 or 3 years here, okay? Or maybe it's a company like Avant Brands. There's a company that's, oh my gosh, their numbers have been incredible. They've been putting up. They've got to get to actual GAAP profitability, net income. If they can do that, it's off to the races with Avant Brands. If they can start putting up quarter after quarter of actual positive net income, it'll be off to the races. And this one will double up, triple up in a pretty short amount of time and then kind of go from there. So I think it's definitely a possibility for a company like that, but they got to get GAAP profitability in the right place, GAAP net income. They got to get that. If they can do that, then we could be talking about this being a realistic next ELF opportunity. But those are some of the stocks that I think have a possibility of being the next ELF. But I think something that's important that I draw to everybody's attention is, you can kind of look at stock market investing similar to like baseball, right? And in baseball, you don't have to have the next ELF to be a successful investor. You don't have to have the next 1,000% stock, okay? The next 10x, 20x, 100x stock. Are those extremely helpful and great for your portfolio? Absolutely. But I look at somebody like Ted Williams, who could be regarded as one of the greatest baseball players ever, if not the greatest, right? Certainly up there. And this man, he certainly didn't hit the most home runs when he got up to the plate, right? He went up at bat 310 times, he hit 29 home runs, right? He went up to bat 272 times, he hit 10 home runs. He went up to bat 411 times, he hit 26 home runs. Those home runs are great, but you don't have to always hit a home run. You got to get hits in this game, okay? And so that's the way I look at stock market investing. It's about getting a lot of hits, okay? Getting a lot of hits. A lot of stocks that make you 20%, 40%, 60%, 80% gains. I mean, the amount of stocks that I've made that on over the past 15 years is such a long list that I could spend all day writing that list, right? And I have been fortunate to hit some home runs, and those are great, but you don't have to hit that. And you're also going to strike out sometimes in this game. People are so scared of the strikeouts. I'm going to strike out on stocks. They're not going to work out sometimes. I'm going to have made a mistake. And the pitcher is going to throw me some pitches, and I'm going to miss them. And that's the bottom line. But you can't be scared of that. That's part of this game. It's like trying to, go up to bat and, being a baseball player and be like, oh my gosh, I'm so concerned about striking out here. I'm not even going to play. That's ridiculous. You don't do that. You don't do that in this market. For a real stock market investor, you're going to strike out. Everybody strikes out. I don't care who it is. Everybody. There's never been an investor who hasn't struck out before and struck out many times. You're going to make mistakes in this game. You're going to lose money sometimes. But the bottom line is you got to get way more hits than you do strikeouts. And when those home runs come through, oh my gosh, can they be game changers for your portfolios? Whether that be an ELF, whether it be a Tesla or many others, right? And so that's just something I think is important that everybody kind of understands. And whether you're a newer investor in the market or you've been doing this for a while, don't be ashamed of your strikeouts. It's part of the process. I'm never, ever ashamed of any of my strikeouts. That's going to happen. I'll strike out again several times over the next 15 years, just like I have over the last 15 years. But damn, I'm going to hit some home runs, and I'm going to run up the numbers, and I'm going to get a lot of hits in this game, okay? And so that's an important factor. Next part I want to bring out is this is a 20-year chart, okay? Super for performers. You either buy more of these stocks or you hold these stocks. Don't be fast to cash, okay? And as somebody that's been in several super performers over time, I've made countless mistakes in selling these stocks way too early for companies that have executed on the highest level possible, okay? And this is the past 20 years for some of these stocks, right? Look at the gains of some of these stocks. Monster Beverage, 125,000% gain in the past 20 years. Apple, 61,000% gain in the past 20 years. Netflix, 27,000% gain in the past 20 years. Nvidia, 25,000% gain in the past 20 years. Amazon, 9,200% gain in the past 20 years. When we're talking about super performers, companies that continue to execute better and better and better and on a higher and higher level, you don't be fast to cash those. Like I said, I've made that mistake in companies before, even ELF. There was a time period when I owned, somewhere around roughly 10,000 ELF shares or so, right? And I cashed and I kept taking profits. I should have held every share I ever owned of ELF. I should have never sold any shares of that stock. Bad mistake. When you got a company that's like executing phenomenal, they got that management team in place, the product service in place, you let that baby ride. You let that baby ride. Don't be fast to cash. These companies, if you're talking about being in a special company, a super performer, they don't go through a 1 or 2 year hot cycle. They go through a 20-year hot cycle, folks, okay? The gains are astronomically, they're life-changing gains. We're not talking about little gains. We're talking about life-changing, okay? You let them run. Let them ride, folks, okay? Let them ride. Believe me, you guys are going to be in some stocks that are going to be in these super performers. And I know there's going to be some people that are going to take profits soon. I remember, because I used to be so into the Tesla community, right? I'm still in the Tesla community, but I'm not at the level I once was, right? Because I used to make so many Tesla videos and whatnot. I watched people sell out of Tesla stock and take profits when that stock went up its first 20%. When it went up its first 20%, there were people cashing shares left and right. When it went up its first 40%, they missed the 500% move in Tesla. They missed the 1,000% move in Tesla. They missed it because they were quick to take a profit. They're like, oh man, made 20%, taking it. It's awesome. You can do that. And there's a saying, you never go broke taking a profit. True. You also can never go rich taking some of these profits, okay? If you want to really live, that type of life, the big house, the cars, the vacations, retiring early, all that stuff, you better let those stocks run. Because I can tell you, you're not getting the big one and taking a 20% gain. That's not happening. It's not happening. Okay? Let that sink in for a moment. You're not getting the big house with a 20% gain. It's not happening. You're not retiring on a 20% gain. You're not buying the car of your dreams on a 20% gain. You're not taking that sick vacation on a 20% gain. Don't ever forget that, okay? Just as somebody that's been in this money game for 15 years, I've seen a lot of people that be very successful, and I see a lot of people that just aren't. And keep that in mind, folks, okay? Obviously, very busy week here. I ran you guys through everything that's going on in last night's video. So if you didn't get to see that, check out last night's video. I ran you through earnings, everything that's going on, Tesla expectations, revenue numbers, EPS numbers, everything like that for the upcoming earnings expectations and whatnot. So yeah, definitely check out that. And last thing is, it'll be pinned comment down there. I put together a great abundance video. It's like a 15-minute video. Put that together a few weeks ago. Very helpful video. If you're feeling any sort of scarcity mentality out there, make sure you check that out. I can send it over via email, text, whatever you want it. I think it's just a very important video mentally for a lot of folks to kind of go through, watch that video and take, just your mindset up to a better level than it's at, because obviously we know it's transpired over the past few years has not been healthy for, I think, a lot of folks' mindsets in the money game. So appreciate everybody joining me as always. Much love and have a great day.